While you were sleeping, institutional investors moved $14 billion into tech stocks. $14 billion in a single overnight session. And they did it while financial media screamed about crashes, corrections, and the death of the tech trade. Someone is wrong here. And historically, it's not the people with $14 billion to deploy. Stick with me for the next 7 minutes because I'm going to show you exactly what the futures market is signaling, which specific tech names are absorbing this capital, and the one data point that tells you whether this is a real opportunity or a trap. Let's start with what actually happened overnight because the headlines are lying to you by omission. Stock futures rose sharply, S&P futures up over 1%, NASDAQ futures up nearly 1.5%. But here's what matters. This wasn't random noise. This was concentrated, deliberate buying into the exact sectors that got destroyed over the past 2 weeks. Now, why should you care about futures? Here's the thing most retail investors never learn. Futures markets are where the big players show their hand before the casino opens. When you see futures ripping higher while regular trading is closed, that's institutional capital positioning before retail investors even wake up. They're not buying because they're bored. They're buying because their models, their teams of quants, their billions in research are telling them something. And right now, those models are screaming, buy the tech dip. But let's not just take price action at face value. Let me show you the money flow data that actually matters. Over the past 5 trading sessions, we've seen something unusual. While the NASDAQ dropped nearly 6% peak to trough, institutional dark pool buying hit levels we haven't seen since October 2023. For those who don't remember, October 2023 was the exact bottom before the market ripped 30% higher over the next 4 months. Coincidence? Maybe. But when I see the same pattern repeating, retail panic selling into institutional accumulation, I pay attention. Now let's talk specific names because not all tech is created equal in this dip buying frenzy. 3 giants are absorbing the lion's share of this institutional flow. First, NVIDIA. Despite the recent pullback from all-time highs, dark pool data shows accumulation increasing, not decreasing, as prices fell. Large players aren't running from the AI trade. They're adding to it at lower prices. Second, Microsoft, the boring tech giant that prints money quarter after quarter. Institutional positioning in Microsoft futures hit a 3-month high this week. Not exactly panic behavior. Third, and this one surprised me, Amazon. After underperforming the tech sector for months, institutional futures positioning flipped aggressively bullish over the past 72 hours. Someone knows something about AWS growth or retail margins that the market hasn't priced in yet. Now here's where I have to keep it real with you, because I'm not here to pump your bags. There's a risk embedded in this setup that nobody is talking about. Futures can lie, not intentionally, but structurally. Large institutions sometimes use futures positioning to create a narrative, accumulate options positions, then reverse. It's not illegal, it's just the game. So how do you know if this is real accumulation or a head fake? Watch the volume formation when cash markets open. If you see the futures gains hold and cash market volume exceeds the 20-day average in the first hour, that's confirmation. If futures gains evaporate on light volume, that's your exit signal. The data is your friend, but only if you know how to read it. Here's what I'm doing with this information. Not financial advice, just transparency about my framework. When I see institutional futures positioning this aggressive, combined with dark pool accumulation at higher levels, combined with retail sentiment at extreme fear readings, I start scaling into positions. Not all at once. Never all at once, but systematically, because this combination has been a high probability setup for the past 15 years of market data. The market rewards those who buy when others panic and sell when others get greedy. Right now, retail is panicking, and institutions are buying their shares at a discount. The question is, which side of that trade do you want to be on? If this breakdown helped you see the market differently, hit subscribe right now. I drop daily analysis that cuts through the noise and shows you what money is actually doing, not what talking heads want you to believe. Subscribe, turn on notifications, and I'll see you in the next one.